Do you have the intention to buy stocks, but you don't know from where to start? We all know that investing in stocks can be lucrative. However, if you don't know the proper investing strategies, you could potentially lose money. So if you are new to the stock market, you need to first learn proper strategies. You can sit back and relax, as I have got your back. Through option trading, investors can anticipate the future track of the overall stock market and individual securities, such as bonds and stocks. Option contracts give you the choice but not the compulsion to buy or sell an underlying asset at a definite price by a specified date. What's up guys, welcome back to Glory Investing Show. In our today's video, I'm going to tell you how to buy options, buy call or buy puts. First of all, I'm going to explain the basics of buying stock options. I'm going to stick to the ticker symbol ASO, which is a big sports store in the South, and I'm pretty much acquainted with them. You guys want to find companies that you're acquainted with and around what price point they normally trade around, whether they're up or whether they're down at some point. Through technical analysis, we can anticipate whether the price is going to up or down during a week. Now when you click trade at the bottom right corner, you want to hit trade options. Let me tell you that the first thing is going to bring you to be all of these expiration dates at the top. We have January 1st, January 28th, February 4th, 11th and 18th. So they're all spaced out at the end of every week, and it's normally every Friday the options will expire now. So what I mean by expiring is that you could sell your options before the expiration date, but if you wait to the expiration date and it's in the money, then your option will be implemented. It means you have the option to do what you said that you're going to do when you put in it. For example, the day on January 21st is Friday. It means your option is going to expire at the end of the week, so currently, if you're buying a call or buying a put, you're debating that the stock will go up by the end of the week and betting that the stock is going down by the end of the week. You might also want to know that if you can go out a couple of weeks, months, or even years in advance, these will be called the leap options, but that's a whole another topic. So let's just stick to the first and main one, that is weekly option plays. Now here it says to buy a call that is betting that a stock will go upward. Right now, ASO prices at $38.83, and it was the click buy put that is betting that the prices will decline. So by call, price is going to go up, and by put, the price is going to go down. Now the numbers on the left side that say $39, $40, $41, $42, let's just say we're talking about buying a call. Those numbers on the side are called strike prices. Here, it is important to note that the strike price means a set price at which a derivative contract can be bought or sold when it's exercised. So on the right, all options are done with a multiple of 100 shares. Now it says on the right here where it says 0.74, multiple it with 100, that would be $74. This is how much an option is going to cost you. If we click on the $39 call, everything going here has a meaning. For instance, IV means something. You do not want to get IV crush, but mainly at the bottom left the Greeks, but the delta is probably the one that is easiest to explain, which is $0.42. This means for every $1 that Academy Sports and Outdoor go up, this option price will go up 42 cents, which is $42 because you have to multiply it with 100 shares. So if ASO went from $38.83 up to $39.83, your option will be going worth from $74 plus the 42 cents, so around $116. You made money that way just from the stock price going up to $1. If you were to buy $74 worth of ASO, which would get around maybe 2 shares worth of ASO, and the price went up to $1, you would have made $2. This is the main reason why people like to do option trading, because you could grow a little amount of money to a gigantic amount of money quickly. So once you do buy an option, let's say we clicked on that, of course it's going to be $74 because you're multiplying it with 100. You could buy one option or two options or more. An option you want to buy, multiply by $74. Now once you put this option in your own one option worth of Academy Sports and Outdoor with a strike price of $39. If ASO climbs up to $39, $40 by the end of the day, you do not have to wait until Friday to sell your option. You could sell your option the exact same day that you purchased it, get your amount back out, and then look for another trade setup. So if you're up 100% or 200% in a single day, or by Wednesday or by Thursday, you could go ahead and sell that option and get out, so a lot of people like selling those options before the expiration date. So a lot of people like to sell the option before the expiration date, such as January 21st or 28th, so that they don't have to have the option implemented. So if you're up and if you're in profit, make sure you take the profit while staying in green and do not let it turn to red. Now we're going to compare ITM options and OTM. Well, let me tell you that an ITM option is one with a strike price that has already been exceeded by the current stock price. On the other hand, an OTM option is one that has a strike price that underlying security has yet to reach, which means that the option has no intrinsic value. A put option gives you the right, but not the compulsion to sell a stock at a predetermined price with a specific time. If you think the market value of the underlying stock will go down, you can consider buying a put option compared to selling a stock short. If you think the market value of the stock will stay on level or go up, you can consider selling a put option. Put options work like a type of insurance for the buyer. A stockholder can purchase a protective put on a stock to help hedge the danger of the stock price dropping because the put gains from the reduction in stock prices. But investors don't have to possess the underlying stock to buy a put. Some investors buy puts to place a bet that a particular stock's value will go down because put options provide greater possible profit than shorting the stock outright. Let's say that I'm going to take profit when it hits the line, and if it pulls back and goes the opposite way, if it goes back to 10% or 15%. I'm going to get out of this grade at this line. If it's somewhere in the middle and not at your stop loss yet, you can wait up to Tuesday, Wednesday, or Thursday until they finally either hit your stop loss and you get out of that trade, or it hits your take profit over the next couple of days and you take profit. So the last one is if bonding call is betting that stock is going up, that means buying a put is betting that a stock is going to go down. And once again, if you're betting that the stock is going to go down, the stock price is going to start to scroll down now and it reflects the price on the right. So if you think ASO is way too high price right now, it's going to pull back. Then for a weekly option, you think that ASO is going to be under $37 by the end of the week, and you could buy that one for $0.63 and you will multiply it with 100 and it will become $63. Well, that will be all for today's video, and thanks for watching it. So if you liked it, make sure that like button turns blue. You can also support this channel by clicking that subscribe button. So once again, that will be all, and we'll see you in the next video.